Good evening, all. Ira Epstein with your financial market wrap-up. And this wrap-up is for Wednesday, the 6th of April, 2022, just after 5:15 p.m. So late in the day, we just saw that the IEA came out and they said that our allies, that's the U.S. allies, are now going to, if you will, release out of their strategic reserves of oil 60 million barrels. So you get ours, you get theirs, and that initially put some pressure on the market, but that'll be absorbed because this is not a solution in any way, shape, or form. If you think it is a sad state of events. It isn't. The solution for higher prices is more oil. It's either more oil or less demand. I don't think we want less demand. We want the more oil in order to control it. Today you did have the heads of Exxon, Chevron, and so on being drilled by Congress. That was a nonsense play. It's good for public play, good for information. But what are they going to tell you? All right? They're going to do what they're going to do, and that's it. The market sets the price, not these companies, if they'll produce. And that's really what these are about. Why can't they produce more? That's what this is all about. When you look at the metal markets and the stock indices, they also have to deal with the Fed minutes that came out today. In a nutshell, the Fed is saying that they're going to roll the balance sheet off by $95 billion each month from the sounds of it. They're going to raise interest rates by 0.5 point. The only reason they didn't do it, if you read the minutes, was they didn't know what to do with the Ukraine war. Now that they know what it is, they make their move, and that's what we're going to have to live with. So I want you to get used to this term. No more quantitative easing. Now it's quantitative tightening. It's the flip-flop of what it is. That's what you've got to think, and that's an enemy of the stock market. The balancing act will be for the Fed to say, can they do all this? Can they run the balance sheet off? Can they raise interest rates? They're talking 8 hikes. They're talking 2.5 points over some period of time and not harm the economy. Well, that'll be the big question from one thing. Can labor, the strong labor market, overcome that? That's going to be a big question. I discussed the inversion. By the way, you're not inverted in the 2 10-year yield anymore. But the inversion that just took place, I talk about the employment, how that counters what the Fed wants to do, strong employment, monthly charts, weekly charts, daily charts, our famous price counts, unique to us, where you get ideas as to where the market might go on swings within the marketplace, and then the all-important seasonal trades. They're so important. How do you view this? Really simple. Just follow me, take your cursor, move it up here, click, fill out the form, and the video will play. Could it be any simpler? I don't think so. All right, so what we've done over the past few days is the market had what I call one of these contra rallies. I will discuss it in a minute. You went up to the 18-week average of closes. I have stuck my neck out here now for 3 weeks saying I do not believe we're going through the all-time highs. I think this is a contra rally, that's it. Market starting to roll, and in midweek, we're down 1.5% and back underneath that all-important average. At the same time, I'm looking at the action we have here, and for the near term, you're in a downtrend, which I wanted to see. This goes hand in hand with the report that I wrote. And you'll say, what's in that report? I'm not going to spill the beans here, but this pulls back with it. So as the market pulls back, you're in a downtrend, but you're in key moving averages. You've come down, you first fought at the 100-day average, then you broke down now into the 200 and the 18, and you're probing tonight those averages again. So the downtrend is here. What could be the further downside? Well, it could be the Bollinger Band, but here's what's going to happen. These Bollinger Bands are doing this. They're wrapping like a teddy bear's in the center. They're wrapping their arms around this in this market. If the market breaks sharp, wherever that's at the support, if it rallies, that's the next resistance zone. Keep that in the back of your mind. This big play has run its day. Now the market's playing with the sideways action here, and I'll repeat, I don't think you're going back for these highs. When you look at momentum, it's down. So you have the trend down, the bias down, you're under this number. To get short here at 44.90 is very dangerous to your health. You'd have to have a stop at 45. 88.75. That's a lot of risk to be having. That's almost 100 points in the market. I think I'd wait on that. And that's here. Now, if you see the report, something else may happen. When you come to the June NASDAQ, it's the same. We were talking here day after day as this market was rallying. I said, this is pretty formidable. I don't even think you're going to make it to the upper Bollinger Band. And I've said it over and over. I don't think you're going back for these highs. And so many people were questioning this rally that you had. Could it really have legs? Could it go? And I frankly don't see how, but it doesn't mean I'm right. The market's fighting its battle, and all of a sudden it let go. And now you're in a downtrend. Why? Momentum down. The trend is now down, and you're under the 18-day average. But again, I'm not enamored with the idea of selling this market here and having a stop all the way up there. That's too much dollar risk. I'll let somebody else want to do a trade like that. It's 600 points, 500 points, 500, yeah, almost 6. No, for a risk. In the mini Dow, trend down, bias down. Well, this market, the sale number is 34,543, and you'd have to have a risk all the way at 35,000, just over 35,015. Even if you use the mini contracts, that's a heck of a lot of risk on my watch. I think I'm waiting. Doesn't mean I won't do something down the road, but I'm not going to do anything right here, I can tell you that. In the Russell, coming down, already oversold. I think major support will be the lower Bollinger Band. On this break, I'm not looking for a big drop. Each drop to the Bollinger Band has resulted in a pop back, at least to the 18-day average of closes. I don't think this one's anyone different. And what a call that we did here for you as the market got up to the 100 in the Bollinger Band. Another thing I told my traders, I've said in here in the month of March, trade light. That's off the table now. I believe that this now, other than the oil market and some of the grains, I think the markets are out of the crazy volatility. I think we're back to livable volatility, and I think I bring the trading programs back to normal. In the VIX cash, I have this big blue line because I didn't think the market was going there. In fact, I was scared when the market was down here going, I didn't think this was going to happen. But if it does, I didn't even know what to say. Embedded reading, trend down. You've cut through the 100 to 200-day average. If it turns up, I'm still looking for wherever that 18-day average is. And yesterday I had a ray of light, and I mentioned it to you. I said, I don't know. This market acts like it wants to pop. And if it does, I'm going to look for the pros if the ones that wrote some calls up here, to call it a day if they get to that 18-day average. And lo and behold, it got there in the 100, and that's where the market stopped. So that's what I think stopped the market. The pros were there. Now in the bonds and notes, they're back to the lower band. This market's a bear market. There's no other way to call it. And the Fed has the bear side of the markets back. You heard what I said. The old days, the market had the stock markets back. You fall too much, it was like they got a call in there. They're going to support the market. Now, if you get up like this, they're not going to stop it, but their actions will. So they're not going to come out. They're just going to keep doing one thing at you. They're going to keep taking the balance sheet down and raising interest rates somewhat. The balance sheet's also a form of raising rates. You know what mortgage rates are today? 30-year, 5.08. So the market's done the Fed's job before the Fed ever arrives at the table. When you get to the 10-year note, you're trading now, let me get to that, in the 2.6 area down here. I'm only looking, my projections aren't for much more than 3% this year, and we're only in April. But I think what will happen is the market's going to do the Fed's job and slow everything down. And I'm not in the school of thought that the Fed has to go with the 8 full cuts. I never have been. We'll see. We'll see just what this all does. The market has had a unique set of circumstances. The supply chain can't fill because China is shut down via COVID. It's spreading in other parts of Europe now, too, and it's nasty. We in America have an advantage over so many countries. So many of our people are now vaccinated. And as they get that, they haven't proven that these new strains, that these vaccines don't work. All right, now we're already giving seniors their second booster shot if they haven't had one in 6 months. I went for mine. I didn't realize it was the 6-month rule, and they turned me down at Walgreens. Okay, but you're oversold, you're coming down, here's the Bollinger Band. I think that's sport. That doesn't mean you can't go lower. There's nothing bullish on this chart, but selling an oversold condition isn't there, but there's an event happening. If you look, both numbers are not under 20, but today, Wednesday, you had your first close under 20 for both numbers, and tonight saying that maybe tomorrow. If you embed again, I'll get very bearish. Dollar index, I'll let the bulls have their day. I teach that when you're not embedded, you hit a Bollinger Band, bye-bye. That's where the pros come out of the market, and the same thing, the flip-flop in the euro as I see it. Then we get to the British pound, which is still very much in a downtrend, lower highs, lower lows. But study this sideways action. I doubt you're going much under the Bollinger Band or above it for a while. I think you're in a trading pattern more than anything else now. Bitcoin. We started talking, at least I did here, that the market right here had lost its embedded reading, was beginning to lose it. It had a 79 and a fraction reading. Any reading under 79 is bearish. Here you have a reading 75. I think you're now going to the 18-day average of closes, and I've said it here for you. This is not a video in which I'm trying to predict for you, sell here, buy there. I'm just telling you what the momentum is, and you can do this all yourself if you take my courses. You learn this theory. Bingo, look where you went today. Now that's all I was looking for, but you happen to be in a downtrend now. So in a downtrend, if, and I'm not saying it'll happen, if it's going to happen, the market wanted to extend to 39,000, very, very possible. A lot of resistance now in the market above it, and you are in a downtrend again. As we step over to the differential between Brent and WTI, you're falling right back to the difference at 547. So you had your peak off of the invasion. It was too much here at the 850, 860 level, and it seems to be between $5 and $6 difference. The market's comfortable with that for the moment. When I look at the energies, they're all in downtrends. Lower highs, lower lows, but you're already oversold. There's no edge in getting short down here. Same thing in WTI, lower highs, lower lows. You're not in an uptrend in these. Heating oil has the pattern of bullishness in the swing line, but you're staying under the 18-day average. And buying, it's got too much risk. This is what I was telling my morning paying subscribers. And in that gas, I'm just very bullish, but if you haven't been able to get in here, you don't want to reach up for it. You let the swing lines work with this. If you're going to lose the embedded reading, you'll see it. Until it's lost, you look for the first hard break, and before you place an order, where's that red line? I'll be talking about that in the morning, and I talk about it regularly so that you could see it. If you haven't seen my morning future subscriber video, I want to give it to you for free, along with my written research. Twice a day I write snippets in the market, and they're not pages of a report. They're paragraphs, very important ones that have bullets. So I'm not going to write pages about what the Fed did. I'm going to give you all the highlights of it. Then I'll give you a couple of sentences underneath. This is what I think. I'm telling you right now. I'm calling it quantitative tightening. So easy to call it that. That's what we're going to be in for the near term. Then I tie that with my morning video. And on the weekends, we have a weekend video where all we do are the weekly charts. And they're for the longer term trader. You know, that type of chart I look at during the week, but it's dedicated on Saturdays typically to that. In the mornings, I will give you specific entry, exit, stop, profit objectives, and all the wisdom using the chart as to what I'm seeing. It works on all kinds of devices, your Android phone, your iOS, tablets. I had a person ask if our Chromebook, he has a Chromebook, he wants to buy the charting course today. I checked on it, it should work. The reason is it's a browser base, and we have that. Even the charting software we have is browser based if you want that. The one you see here is my download version, but you can try even that for free. How do you do this? Just go to the website, under free offers, give it a click, enjoy. I'm Ira Epstein. Have a great day.